Hello and welcome to Chapter 6, Forex Futures Trading. Unlike spots, forwards and swaps transactions that have already been carrying out on the Vietnamese foreign exchange market, futures is not yet available. However, it is very popular with foreign exchange speculators. So, let us discuss the similarities and differences between this and the other operations that we have learned in previous chapters. The goals that we need to achieve after finishing this Chapter 6 are: first, understanding what is a currency futures trading or a FX futures trading, and then able to list the basic characteristics of this type of transaction. Second, distinguishing between FX futures and FX forwards transaction, which was introduced in Chapter 4. Next, understanding the organization of the futures market and be able to describe the organization of this market. In addition, when it comes to FX futures trading, it is indispensable to mention the re-evaluation mechanism according to the market price at the end of each day, called mark-to-market. After studying this chapter, you will be able to explain this mechanism as well as practice this operation in some specific situations. Next, we need to understand the applications of this type of transaction. And the ultimate goal is that you can appreciate the advantages and limitations of FX futures trading, so that you can choose to use this transaction in practice. To achieve the goals listed above, let's start with the first topic, Forex futures trading overview. Topic 1 of Chapter 6 will help you understand the concept of Forex futures trading. In addition, the unique features of this type of transaction will be introduced to help you distinguish it from a learned transaction, the Forex forwards trading. According to the textbook Foreign Exchange Trading, 2017, by Associate Professor Dr. Nguyen Minh Q, a foreign exchange futures transaction is an agreement to buy and sell a certain amount of foreign currency at a fixed rate at the time making the transaction. And the transfer of foreign currency will be conducted at a future date determined by the exchange. This is also the understanding according to international practice of foreign exchange futures trading. Thus, it can be understood that a futures transaction is an irrevocable agreement that must be performed. That agreement is about buying and selling a certain amount of foreign currency. The exchange rate applicable in this agreement is determined on the date of signing the futures contract, also known as the trading date. And the transfer of foreign currency will be made at a future date. Up to this point, you will see that futures trading is very similar to the foreign currency forwards you learned in Chapter 4. But what makes the difference between futures and forwards trading is that the agreement to buy and sell in a futures trade is made at the exchange, and the future delivery date is also determined by the exchange. Trading foreign currency futures has some features as follows. Firstly, this is a transaction that can only be performed at the exchange. Second, the contents of futures contracts are standardized. Third, futures trading is an irrevocable transaction. However, investors can easily close their positions when participating in the transaction. And finally, futures contracts will all be revalued at the end of the day according to the closing price on the exchange. Let's look into these features to better understand futures trading. The first feature is about the trading location. Futures trading is only conducted on the centralized market, or in other words, futures trading is done only at the exchange, called futures exchange. This is different from the types of transactions we have studied in previous chapters such as spots, forwards or swaps that can be performed on the open market. This is similar to the operation of the stock market, which also trades on a centralized market. At the futures exchange, information about contract prices and other contract regulations will be publicly listed on the exchange. The major futures exchanges in the world today can be mentioned as CME, NYMEX or CBOT. In Vietnam, there is currently no futures exchange, therefore, futures trading has not been performed. Because it must be done at the exchange, investors when entering into futures contracts will have to comply with the regulations set forth by the exchange. For example, an investor who wants to sign a futures contract will have to make a deposit. And while the futures contract is in effect, investors are required to maintain a margin account balance that cannot be less than a defined level set by the exchange, known as the maintenance margin level. In addition, at the exchange, there is a department responsible for monitoring the current contracts in force to evaluate the profit and loss of these contracts according to the closing price of the market at the end of the day. This department is called the clearinghouse. The details of future market organization will be presented in more detail in the following topics of this chapter. The second feature is that futures contracts are standardized. These include currencies, sizes, deposit, and finally, payment date. That is, issues such as the type of foreign currency to be traded, the amount of foreign currency to be traded, the amount of the deposit and the date of the payment will not be decided by the investors according to their needs or desires, but will be predetermined by the exchange. The exchange will develop and issue general regulations on the contents of futures contracts and require all participants to comply. These are: for trading currencies, not all currencies are traded on the futures market. In the futures market, only certain types of currencies are allowed to be traded. For example, at Chicago Mercantile Exchange, one of the oldest futures exchanges in the world, only a few currencies are traded such as Australian dollar, British pound, Canadian dollar, euro, Japanese yen and Swiss franc. US dollar will be considered as the payment currency when trading the above-mentioned foreign currencies. Second, about futures contract size. That is, the amount of foreign currency bought/sold in a contract is also regulated by the exchange depending on the type of currency traded. At CME, if you want to enter into a futures contract to buy or sell odd, the standard contract size is 100,000 Australian dollars. If you sign two contracts, it means you will buy/sell 200,000 Australian dollars. Investors will trade quantities of foreign currencies in multiples of the standard one contract size set by the exchange. Similarly, the deposit amount is also regulated by the exchange. The margin level depends on the type of currency and the number of futures contracts signed by the investor. Exchanges will provide initial margin and maintenance margin for each currency corresponding to the size of each contract. Investors base on the number of contracts they sign and the type of currency expected to trade to determine the initial deposit amount to enter and the corresponding maintenance margin level. And finally, the payment date, that is, the date of currency delivery. Unlike in other transactions, which the payment date would depend on the investor's demand, in the futures transaction, the settlement date will also be determined by the exchange, usually a specific number of days in the year. On this slide, you found some standards for futures contracts as regulated by the Chicago Futures Exchange. The allowed foreign currencies are shown on the first line. Next is the size of each contract corresponding to each currency. For example, the size of one futures contract to buy or sell Australian dollar is 100,000 Australian dollars. The size of one futures contract to buy or sell British pound is 62,500 British pounds. Next is the information about the deposit amount, including the initial deposit amount and the maintenance margin amount. The third feature is that participants can easily close their positions at any time. Foreign currency futures trading is also irrevocable, but an investor can easily close his position at any time by performing a reciprocal trade with the exchange. Look into the following example. On November 12, 2018, investor A signed a forward contract to buy 100,000 Australian dollars at the exchange rate of AUD USD 0.7075. Payment due date is the 12th of December 2018. On November 12, 2018, Investor B signed a futures contract to buy Australian dollar at the exchange rate of AUD USD 0.7075. The size of one contract is 100,000 Australian dollars. Payment due date is the 12th of December 2018. When signing a contract to buy foreign currency, both investors A and B are maintaining a positive foreign currency position, also known as maintaining a long foreign currency position. Assume that on the 8th of December, the AUD USD exchange rate in the market is 0.7100. Thus, investors A and B are both earning a profit. If right now, two investors get 100,000 Australian dollars to sell back in the market, they will get a profit equals 0.7100 minus 0.7075 equals 25 points per Australian dollar. However, for investor A, this return is the expected return. Because the signed forward contract will only be expired on the 12th of December 2018. Assuming, on the 12th of December 2018, the AUD rate is not at 0.7100 but drops to only 0.7075 or less, then investor A's profit is no longer there. Even a loss is possible. That is also the feature of forwards trading, which is only interested in the exchange rate at due date, not the exchange rate fluctuations during the effective period of the contract. As for investor B, on the 8th of December, he can exit the AUD long position to realize his profit by on the 8th of December. He therefore will sign one contract AUD short futures with the clearinghouse. The contract size is also 100,000 Australian dollars. The due date is also the 12th of December 2018 and the exchange rate is AUD USD 0.7100. Thus, by selling the originally signed futures contract, the investor exits the AUD long position, and receives a difference between the two contracts, equal to his own profit of 25 points per AUD. This is how an investor involved in futures trading can quickly close his or her position when the rate reaches the expected or desired level. Thus, if an investor is holding a long position, that is, signing a futures contract to buy a currency, and wants to close the position, that investor can simply sell the existing futures contract to the clearinghouse, bringing his position back to equilibrium. Conversely, if an investor is holding a short position, that is, signing a futures contract to sell a currency, and wants to close the position, the investor can simply buy the corresponding futures contract from the clearinghouse to bring his position back into balance. Thus, futures trading allows investors to exit long or short positions at any time according to their wishes. This helps investors be much more proactive in locking in their profits or losses. And in fact, according to statistics, most futures contracts are settled prematurely this way. The final feature is that futures contracts are all revaluated at the end of the trading day. At the end of each trading day, the clearinghouse will rely on the closing rate of the day to calculate whether the ongoing futures contracts have increased or decreased in value compared to the previous evaluation time, usually the end of the day before. The revaluation of futures contracts is intended to help determine an investor's actual profit or loss at market price at the close time. If at the end of the trading day, the contract value increases compared to the previous evaluation time, it means that the investor who signs a futures contract to buy foreign currency will make a profit. And this profit will be credited to the investor's deposit account. On the contrary, if at the end of the trading day, the contract value decreases compared to the previous evaluation time, that is, if the investor signs a futures contract to buy foreign currency, he will suffer a loss. The loss amount will be deducted from that investor's margin deposit account. The revaluation of futures contracts at the end of the day is done automatically every day by the clearinghouse. The rate for revaluation of futures contracts is the closing rate at the end of the day at the exchange. The process of revaluation of futures contracts is called mark-to-market, and some textbooks call it market scoring. This process helps investors determine their profit and loss during the futures trading process, as well as helps the clearinghouse know the amount of money available in the investor's margin account to request additional margin when the margin account balance is lower than the maintenance margin level. After learning the concept of Forex futures trading, you can see that futures trading and forwards trading have a lot in common. The key difference is that forwards trading is done on the over-the-counter market, while futures trading is done on the centralized market. However, this difference leads to a lot of different characteristics between these two types of business. Let's compare futures and forwards trading to see how these two operations have similarities and differences. The first similarity is that both types of transactions are irrevocable agreements. That is, participants in a forwards or futures contract will have to strictly comply with the agreements in the contract, not having the right to cancel the contract. The next common point is that the exchange rate used in both futures and forwards transactions is determined at the time of the contract is signed, but the transfer or delivery is done in the future. These are common features between futures and forwards trading. So what are the differences between these two? The first difference is in the way of quotation. In forwards trading, the quoted exchange rate is the rate calculated and offered to customers by banks. Therefore, each bank can offer customers different exchange rates. As for futures trading, the exchange rate is publicly listed at the exchange. This rate applies to all customers participating at that exchange. The second difference is about the type of currency to be traded. FX forwards trading can be done with any foreign currency depending on the needs of the customer. In contrast, for futures trading, only those currencies listed by the exchange are traded. Even if the customer wants to execute futures contracts with other foreign currencies, it is not possible. The next difference is about the issue of revaluation of profits. Forwards trading does not have a mechanism to reevaluate profits at the end of each trading day. As for futures trading, futures contracts will be re-evaluated on the basis of the closing rate at the end of the day to determine how much money an investor will gain or lose at the end of the day. Because of this difference, the risk level of the two types of transactions will also be different. Since the contract value is not revalued every day, forwards trading carries a higher level of risk if the market rate at contract expiration differs greatly from the rate on the contract. As for the futures contract, the revaluation of the contract value at the end of the day is done automatically every day, so the risk level will be significantly lower. Standardization of trading is also a difference between futures and forwards trading. For forwards transactions, the transaction process will be built by the bank itself. Each bank will have its own process to suit its characteristics and size. In addition, the contents of the forwards contract are also mutually agreed upon by the customer and the bank. Depending on the reputation of the customer and the size of the contract, the content of forwards contracts between different customers will be different. Futures trading is the exact opposite. From the trading process to the content of the futures contract, everything is standardized by the exchange and applied to all participating customers. One main difference between forwards and futures trading is the contract size. Futures trading is standardized by the exchange, including the issue of contract size as we discussed in the previous section. As a result, futures contracts of corresponding size and value are often quite small. This allows retail investors to easily participate in the futures market. As for forwards trading, there is no regulation on contract size or value. Hence, in reality, there are some enormous forwards transactions in the market. This makes it difficult for retail investors who want to do forwards trading. Margin is also another difference between forwards and futures trading. In forwards trading, margin is optional. However, in reality, depending on the relationship between the bank and the customer, as well as the reputation of the customer, The bank may require the customer to deposit or not, and the deposit amount of each customer may also be different. In addition, in forwards trading, the customer will fulfill the margin obligation by maintaining an amount corresponding to the margin requirement on the bank's current account. In many cases, the client also does not need to replenish the margin if the market fluctuates. In contrast, for futures trading, the margin amount is regulated by the exchange. In order to participate in the futures market, clients are required to deposit a margin amount called initial margin. This amount is deposited into the client's escrow account opened at the clearinghouse. In addition, during the validity of the futures contract, if the balance on this margin account is lower than the maintenance margin level prescribed by the exchange, the customer will be required to deposit more money to the account. And the final difference between futures and forwards trading is the issue of closing the trading position. In forwards trading, once the customer has signed a forward transaction, the client is required to maintain a short or long foreign exchange position for that forwards contract until the contract's expiration date. As for futures trading, investors can completely get out of a long or short position by making a transaction with the clearinghouse to balance their foreign exchange position. This makes it much easier for investors to take profits or cut losses when the market has large fluctuations in exchange rates. Those are the differences as well as the similarities between Forex futures trading and forwards trading. Thus, closing topic 1 of Chapter 6, you have understood what is a foreign currency futures transaction, its specific features, as well as distinguishing between futures and forwards transaction which shares many similarities. The next topic of the chapter will help you learn more about this operation as well as provide situations where you can practice Forex futures trading. This is the end of topic 1 overview of Forex futures trading. After this, you should be able to define the Forex futures transaction, list its features, differentiate between futures and forwards transaction. Some questions are provided at the end of this chapter to help you review this topic. In the next topic, we will look into the practice of futures trading. See you then.